I spend 4 days of my week working with my colleagues at Rock Partners. Rock Partners is the private equity firm you've probably not really heard of, but they have $9 billion of funds under management here in Australia. They operate very closely with all of Australia's largest superannuation funds, and they've been involved in directing funds into private equity for over 20 years now. They were formerly a part of Macquarie Bank, and in 2014 spun out. One of the reasons for spinning out was they wanted to explore other areas. When you work in a large institution, life can be very siloed. So when they wanted to explore other areas, they kept bumping into other people, so it was easier for them to move outside the organisation. One of the first areas they explored was agriculture, and that's really quite challenging when you think about it, because those of you who are familiar with agriculture in Australia is that there's lots of investors, but not really all that many Australian institutional investors. Now, what the guys from Rock have managed to do and do very, very well is to engage the Australian superannuation industry to invest in ag. So we've got $2 billion of funds under management, most of that to do with Australian agriculture. You'll hear a lot of talk about why isn't Australian institutions getting behind Australian agriculture, and the answer is, well, they actually are. They're just looking for the types of deals they want to do. And at Rock Partners, we work, given our heritage is private equity, we've looked at agriculture with that sort of lens. How do we go about agriculture in a way that creates the sort of returns that will interest people like the Australian institutional investors? And the way we've approached that is we've looked at where we can invest and where food is, where you can actually achieve higher returns. And two things we know for sure is the closer you get to the consumer, the better, and that's part of the private equity background of the business. And the other thing is that once upon a time we used to eat food just to fill our stomachs. Food was a commodity. But as we've all got a couple of pennies extra, and as our economies have progressed, we now all have surplus money. And as we look at food now, food becomes in part discretionary. So we'll choose food. We'll choose food that gives us a great experience. We'll choose food that's good for us, or we'll choose food that is convenient. And in each time, we're actually not buying food. We're buying an experience. We're buying health. We're buying time. So you get a premium on the value of your food, and they're the sorts of areas, by and large, we've operated in. So we've got a private equity approach to food, and more recently, we've been looking at how we fund infrastructure in the food space. So we've got a fund that's looking at that, lower returns, again playing to where we think the institutions are. Some of the other hats I wear are with the Australian Agricultural Company, where I've been very fortunate to sit on the board and observe the transformation of that business. And people sort of forget this, that was a business that was 19 cattle stations, all having a wonderfully good time doing their own thing, selling cattle to whoever they wanted to, and that was 10 years ago. Today, that's an integrated supply chain with developed brands selling high-quality branded Wagyu beef around the world, doing fantastic stuff there. And it's been interesting observing that transformation in that company, because I think what that company's doing there sends a really nice signal. If that can be achieved there, where else can we take agricultural production, upscale it, lift up the value and tap into those markets? And that's been a fantastic ride. And then finally, I'm really, really lucky to work with the guys at Clean Energy Finance Corporation. At first, I was surprised when they asked me to come in for a talk. I said, mate, I'm agriculture. You guys are doing, wind farms and solar panels. And they pointed out that the Australian agricultural industry's emissions are out of step with its contribution to GDP. And what they wanted to do was to see what they could do to change it. And they've done a bunch of work. What they want to do is to show farmers that they can deal with climate in a manner that's not detrimental to what they're doing in their farming operations, and in fact may be profitable. And I think we all have a sense for how that can be done. And they've made some good investments, and I'm pleased to say that one of the investments that we've made has been with Brad and the guys at Gunn, and we're really happy with that and the approach that they're taking. What am I excited about in agriculture? I think I'm excited because I think consumers are becoming more and more discerning, and that's not concerning. No, they're becoming more and more discerning, and there's a great opportunity for farmers to get closer, or agriculture to get closer to the consumer. Now, farmers never had to deal with the consumer before because there was always the egg board, the wheat board, and some other board, and everything was channeled through them. So this is an untapped resource. As agriculture, as an industry, gets closer to its consumer, it will tap into what they're looking for. And I think the ability to raise the returns that we can earn collectively across the industry is there. What concerns me, at the moment, I think the weather. It's a very, very wet year. It's very challenging, I think, for all of us in the industry. We've been looking for rain, probably not this much. But I think the next couple of months, with not a lot of wet weather coming through, will test us. I think those of us that manage that situation well will do well.
Yeah. So Andrew Tout, I work with a group called the Centuria Property Investment Group. They've been in existence for about 25 years. ASX listed group with roughly 20 billion of assets under management. They've got a fairly wide spread of investment classes, so they're in large format retail, commercial, industrial, office, etc. And about 3 years ago, they made the conscious choice to do what a lot of people are doing and invest into agriculture. And so they've gone in reasonably carefully, taking a very much a sale and leaseback approach, doing very similar investments to what they're doing in the other asset classes, and just trying to find good, solid assets in good locations with good operators. And one of the investments that we've made is with the Flavorite Group, which is all of those things. And so the journey so far has been really about trying to invest into areas with some sort of controls around those environmental impacts that we're seeing, so glasshouses, protected cropping, ag tech, all of those areas, but leaving the farming up to people who are expert at it. And it's been a really important part of the journey, has been seeking out operators and seeking out tenants for the properties that we're buying, because it's a very limited pool within Australia. It's still very much an emerging class, and I think there's been a few failures along the way. I think the last 10 years there's probably been a little bit of get out of jail free cards as well, with a big increase in capital values of farms. And so I guess for me, when you're looking at the current investable market in Australia, what excites me is just how resilient the farmers have been through these cycles of drought and flood and increasing capital values. At the same time as that's occurring, 14 odd % that properties have gone up in value since 2014 to now. Commodity prices, if you just look at the softs, has been about the same. So the actual income generating capacity of those farms has gone up in line with what we're seeing as the increase in value that a lot of people are saying is crazy and is too much. But I think it's because of the growing demand that we're seeing, particularly out of Asia. We've gone from 50 billion to 60 billion to 70 billion to 80 billion of production, and the more we produce, the more gets taken. And so we're quite comfortable or buoyed by the tailwinds that we're seeing for the industry. It's a space where we've got very strong interest as well from our investors. And for our group, the majority of those are retail investors and high net worths, and so it has, to get the fund from where it was at zero up to just under 400 million in the 3 years has been pretty challenging. Only a week ago, we got our second staff member, which is good. So I'm going on holidays for a week. So I'm buoyed by the excitement that there is from investors, but I'm also really excited because the actual farming assets can afford to fund that growth. And so we're talking about the future of funding in agriculture, and where is that funding going to come from? It's actually going to come from farmers producing a commodity that pays for the debt or the equity or whatever it is that comes from markets like we're talking about. So that excites me. What keeps me up at night is probably some of these external factors that we can't control that are having an impact on the viability of some of our operations, with increased gas prices and with debt costs going up, some of those things. So that, in general, I'm just excited about the future prospects for ag as we move into more corporatised farming, and still be lucky to be any more than 3% of the market is corporatised, and I think that's where the opportunities are for us.
Brad Wheaton from Gunn Agri Partners, and just a little bit about our organisation. So we're about 10 years old. We were founded by Bill Gunn and then 3 people that were out of Macquarie: Alan, Hoppy, Dan, Huff and myself. So on the panel here, we've got a Macquarie spin-out, a kind of Macquarie spin-out, and someone in the middle that just bids against Macquarie. So it is a small industry, as we all know. So Gunn Agri, we've got a touch point with financing in 3 very different ways. Our traditional business, which is our funds management. In that business, we manage the Gunn Agri Cattle Fund. We manage the Transforming Farming Platform, and Abe's mentioned that the CFC is a co-investor alongside an impact investor from the Netherlands in that strategy, and the operating company for that strategy is called Faulkner Farming, and we've also got a permanent crop strategy called Wallamar Farms, which owns some orchards in New South Wales at the moment. We also have touch points with corporate advisory, and Ben Craw's the head of Oxley Capital, and Gunn Agri is very proud to be a partner with him in that business, and that gives us a lens over a whole range of food and agriculture transactions in the debt and equity space. A really, really exciting business, and we're really happy to be working with him on that. And he's got some of his team here today as well. And then we've also got an interest in a livestock lending business, and that gives us a very different exposure to the livestock industry to what we've got. In terms of what keeps us up at night and what excites us about the industry, so what keeps us up at night now is talent, and we're very fortunate to be going through a very rapid growth phase. We're deploying for 2 strategies at the moment, and we're getting ready to deploy for another one. At total AUM at the moment is 500 million in funds under management and commitments, and that's will grow with future commitments substantially over the next few years. And so we're in the middle of a recruitment effort, and we're recruiting on farm, and we're recruiting for Gunn Agri corporate, and we're recruiting different people than the sort of roles that were around when I graduated from ag science in the year 2000. We're looking for people who have got capability and experience in thinking about agriculture with a sustainability lens, thinking about agriculture as a form of natural capital. And that's because that's what our investors are demanding from us. And obviously the CFC they're a for-purpose but commercial investor. But what we're seeing generally across the board is that these investors, these institutions that invest in a lot of the businesses people are involved in here, pension funds and super funds are kind of democratic. They have members. Their members require their boards to invest in a certain way, and what's happening is that way of investing is starting to be more impactful, even though it is very much traditional agriculture investing. So one of the things that not only is a concern, but it's also a great opportunity, is finding that talent that can help us grow. And the positive opportunity that we see is facing that market and adapting to what that market wants. And Australia and to a greater extent the US have been living in a bit of a bubble or on an island for a few years now. The rest of the world was heading in a direction, reacting to climate change is one way to easily think about it, but it's a whole range of thinking, including natural capital in your considerations with what you're doing in your agricultural investments. So we didn't really, we had an effort to try and incorporate that in agricultural investing, but what's really unlocked the potential has been changes in policy in the US with the change in government there. In Australia, a change in government has continued that momentum. And a whole range of different reasons. That's oversimplifying it grossly, but the result I don't think anyone can disagree with. That today, as a player in agriculture, Gunn Agri can have a conversation with equity providers and debt providers, and they want to know what we're doing in terms of how sustainably we're managing those investments. Not only do they want to know, but they want to be able to quantify it, and they're prepared to provide incentives, i.e. Bottom line, things that hit the bottom line, if you're able to be able to demonstrate that you're achieving what you're aiming to, the impact that you're aiming to have. That's a quantum shift. So we ran a finance process recently, and the overwhelming majority of the 5 banks, it placed a huge importance on what we were doing as a business in terms of sustainability, and that's a great outcome we see, and that'll continue, and that'll work its way out of not just institutional investments in agriculture, but more of the industry, more of the traditional mums and dads, and that is happening. From an equity perspective, we're seeing a lot of the European and North American investors, which have been chasing this for a long time. But we're also seeing the Australian supers, and Abe's made the point before, there's this age-old debate, Barnaby used to, bash Australian agriculture bash Australian investors for not investing in Australian agriculture every chance he got. But the reality is that there has been investing in agriculture by Australian institutions for a very long time. It's just become a lot more sophisticated and deliberate. So the private equity space is, and particularly in Abe's business, is one area where they seem to be really comfortable getting exposure. I think it's fair to say that your traditional owning land, even owning water, has not been something that you've seen Australian institutions invest in at the same rate as your Europeans and your North Americans. But one of the opportunities that we see to bring the broad base of Australian capital back into the fold is being responsive through incorporating sustainability in what we're doing. So Gunn Agri sees a huge opportunity for that. We are actively engaging not just with overseas investors but with Australian investors, and we hope that they will play more of a role in our industry as we continue to feed and clothe the parts of the world that we can.
There's a lot of talk about the role of government in regulating offshore investment into agriculture. Have we got that balance right at the moment, and do you think that's going to have an impact on financing in the future?
Good point, Ben. Most people may not know, but the current federal government went to the last election with a policy to increase FIRB fees, and they have put that in place. So it's essentially doubled FIRB fees. So FIRB fees have gone from something that kind of was comparable to what your lawyers will charge you, and if they're expensive, and most of them are, to something that now is the big ticket item in a transaction. And what we can see, and the problem is that politically, people that complain about FIRB fees don't really have much traction. But as an industry, we should care, because foreign capital has been in agriculture for many, many years. And 100 years ago it was British money, and 50 years ago it was probably mostly American, and then Japanese and European, and for a while it was Chinese. And we have grown as an industry with foreign capital, and our country has grown with foreign capital. I think the debate around foreign capital being, on the whole, something that we want is not a debate. So why are we charging way more than the cost of providing a service to monitor? And essentially what everyone, Australian government policy is, which we support, is monitor foreign investment, and anything that's really contentious, let's challenge it and let's vet it, and the Treasurer should vet it. And there's been less than a handful of deals that have been highly contentious, that have been pushed back on, adapted or rejected. So this is really about a monitoring and a reporting, and what we have is fees that are becoming inhibitive to the future investment in the industry.
Gents, anything you wanted to add to that?
Most of the investment in Australia is foreign. It's just that the face changes from time to time and the excitement level ratchets up a touch. But anything that limits foreign investment in Australian agriculture is really just a tax on people who own assets here. Like when you limit the number of people who can come into your market to buy, you necessarily limit the the value of the assets, so the assets don't get to their natural value, and those who are local get to pick them up at unders. The problem with agricultural land is it's a bit romanticised, and somehow we think it's more important than other assets and other businesses that are out there. So I'd be embracing foreign investment. There's the food security issue. What happens if people come and take all our land and take all our food? Well, the reality is we are girt by sea, and food can't leave here if we don't want it to leave here. So to the extent that there is money which is foreign money or offshore money that wishes to come here and invest, I think it's a great vote of confidence in the Australian sector. It should be encouraged. Fees and all that cause it issues, should be limited to the greatest extent they can.
I might stay with you, Abes. Over the many years of farm ownership in Australia, we've seen farms go from very, very big to, we had a sort of a social experiment around soldier settler blocks where we made farms much smaller again, and we seem to go back into a period of consolidation. Do you think that's a long-running trend? Are we going to see that continue, or is that something that'll change again in the short term?
Yeah, it's interesting. People used to be able to make a good living out of a small block. And at that point in time, I think when the first F.J. Holden came out, you could have sold, I think the number's 20 or 30 cattle and bought an F.J. Holden. So if you wanted to buy, you can't buy a Commodore now, but assume that you could. I don't know how many cattle you have to sell, but it's somebody can do the maths.
Probably 5.
It's a whole bunch. No, they're not that cheap. Come on, guys. Maybe it's come back up, but what's happened is that the terms of trade between agriculture and the rest of our life have moved, and they've generally moved against agriculture. And it's in government's interest to make sure that food stays cheap, because that keeps the masses happy. So what happens is farmers effectively, food prices get lower, manufactured goods go up. So therefore that small block that used to be able to provide a good living for people can no longer provide that living, and what you need is scale. So you've had to get a little bit bigger, a little bit bigger again, a little bit bigger again. So farms now become very large as we chase the sort of economies of scale that we need to remain competitive in a world where our prices go up faster than the value of our of the produce that we produce. What we've seen by and large is a change in the nature of the investor that goes into agriculture. So the nature of the investor going into agriculture has to be bigger. You get corporates coming in, you get institutions, many of them offshore but increasingly Australian, and you get the larger farming families buying up more and more. So it's getting bigger and bigger and bigger, and that's just the way. And quite frankly, that's not different to a whole lot of other parts of industry. There is, however, this interesting development. Now, if I use the letters MIS, people will start rolling their eyes. But the concept, you got to distinguish between the concept and the execution. The concept was you took an agricultural enterprise, you broke it up into a bunch of pieces so that people could buy it bit by bit, and you could access the sort of management and properties that you couldn't access by yourself. Now, MIS has come and gone, but what we've started to see, really interestingly, out of the US is a model where they come to Australia, they buy a property, then they put that property on the market in the US, and I think they sell shares in a company or something like that, and they're raising, $40-50 million in, 15, 16 hours. And each person that buys into it is buying into a particular property. So it's sort of interesting, I think, that we're starting to see, who knows how big this will get, but out of the US there's certainly an interest in a whole bunch of smaller people coming together to buy properties, which is sort of almost MIS in nature. However, it is bucking the trend of very large, only the large institutions doing this investing.
And just on that, I might move to you, Andrew. You've just gone through a process of raising another couple of buckets of capital. Within Centuria, which is a very, very large business, how have you found getting airtime around ag? And then when you went to the market, what was because I understand that you weren't necessarily focused at the super fund, but very much in the local investment market. How did you find the appetite for the product?
So it was an interesting process. I mean, we started with a roadshow. We went pardon me, around all the capital cities, had investor meetings. We weren't just talking about agriculture, we were talking about opportunities in healthcare and other parts of the business. And fair to say, though, the overwhelming sentiment in the room and most of the questions were about agriculture, and there was a huge amount of interest. There was probably the amount of people who invested initially was far less than you would expect from the interest. But when we actually got going, we had to raise 103 million, and we weren't sure how that was going to go. And it was a reasonably quick process, surprised by the appetite and pleased by the appetite.
I've got one more question before I turn over to the audience. So ESG, in terms of where we're at now and the journey we're on, how far along are we, and how much more pressure and change are we going to see in what we do day to day, driven by the ESG, I guess, argument or driver?
Well, from our investors, the ESG is a very important thing to them, and so we have, strategically had a big focus on ESG. Obviously, we want to focus on very profitable businesses, but we also want to focus on trying to give our investors what they want, and so we are looking at things that do have a higher ESG credential, water use efficiency, lower exposure to the elements, and a lot of those things we are getting external consultants to review for us as well, because it is a box that you have to tick, and if you can't tick it, you're going to exclude a lot of people from investing in you.
I think so. There's a lot of focus on ESG now, and it's coming from investors. So when investors come in, they're looking for reporting on ESG. When we take investors on, we go through a whole lot of ESG due diligence. At AACO, we issued our sustainability statement last year, so there's a lot of focus on it. I think it's interesting that a lot of stuff that's in those around sustainability is what farmers do. So Australian agriculture is generally pretty good at sustainability. It does a good job there. There are extra things that they're looking at now, but in addition to that, they're really documenting a lot of stuff that they do. I think the pressure around ESG or disclosure or statements of ESG will become more and more, but not necessarily from the investors. I see it as much from the consumers, and you may recall earlier I was talking about consumers now have discretion when they buy food. And consumers are increasingly looking at what the food that they're buying and the way it's produced, and they have an expectation that they're comfortable with the way that the food was produced, that the assets that were being used in the production of that food are being maintained in a sustainable manner, and everybody involved in that supply chain is being dealt with fairly. So I think that pressure will continue to come through for those who wish to sell product in the market, and we'll see a push also from the investors, which, as Brad points out, the same people who are out there, choosing which food they buy are choosing which super fund they invest in, and they make their choice exactly the same way. So I think this is going to be, people power that push this, which is, wonderful, and it'll be interesting to see just where the government gets involved in it.
And just to wrap up, with the E, the S, and the G, really the big issues that of our time are really in the E. But just a point on the S before we start, the strength of agriculture and the ability to enliven communities it can't be underestimated. And you can get a great coffee in Moree and Gunnedah. And when I grew up, Gunnedah was the main street was probably half boarded up, and there's some coal mines and things around, but you get the point. Healthy agricultural industries do support really healthy local communities, and institutional investment in agriculture, strengthens these communities. They bring talent in, bring new skills in, and it's a part of our industry that we don't really tell that story enough. With the E, just two specific points. the future that we see is the next generation, away from sustainability or environmental washing statements that aren't founded in evidence. We see the future as being able to report on accurately and objectively what impact you're actually having, and being able to demonstrate it to not just your investors but your other stakeholders, what impact you're having, what impact you aim to have, and then whether you're actually achieving that. And you're seeing that this is a sphere of policy which is a lot further advanced in Europe, and it's going to become more of an important part of managing the environmental aspects of what we do. And then the second point to make is obviously around carbon or greenhouse gas emissions generally. We still are at a very early stage of this industry. There's let's not call it a gold rush, but there is still inefficient activity in the industry. We've still got an industry which is very much not necessarily fair and equitable around the returns which are being derived from the people selling the picks and shovels and the people that are doing the actual work. And so what we'll see, we think, is some regulation of the industry, which makes actually establishing what is an ACCU or a carbon credit a bit more balanced. And also there really does need to be more of a commercial change where those service providers to farmers do develop these business models which are fair, or which aren't based around taking 40% of the spoils and that being the only opportunity, but something that's a bit more like what an agronomist might charge you, in line with the value that you're actually getting. And so we see the opportunity for climate change policy in agriculture to really develop, and that for the whole industry. That's certainly not something specific to institutions.
Ladies and gentlemen, over to you. Not often do we get an opportunity to question gentlemen like this, so please, question over here.
Hello. Hi, thank you for the presentation, gentlemen. I work for a company called StoneX, and I've been working the physical grain markets. Would like confirmation from Tony. When will we get the official confirmation whether one of your investments from 2-3 years ago, Emerald Grain, has been sold potentially to Louis Dreyfus? And two, maybe for the rest of the group, anyone who's invested in agriculture 2-3 years ago looks at the moment like a hero. When's the time to get out? What's the exit strategy? Are we at the top of the agricultural super boom? I mean, it's been amazing running agriculture. Anyone who's in it, and I'm in it every day. So, a bit of guidance from you guys. When do we get out and cash in? Thank you.
If I knew exactly when to get out and cash in, I'd be on an island in the Bermudas right now. So not really sure about that. So I'm not sure. So grain pricing cycles isn't my bag. I might leave it to one of my colleagues here.
Yeah, look, I think I said it earlier that I'd looked into sort of over the last 10, 12 years where soft commodity prices had gone, and it had increased on average about 13% a year. Property prices had increased about 14% a year. Yields have increased. At the moment, yes, it does seem as though there's been a massive increase in value in farms in Australia and money invested into farms in Australia, but the farmers are keeping up with it. So I don't think the terms of trade are any worse. I think you could have bought a Holden for whatever bags of wheat 10 years ago. It's about the same today. So we're holding our own at the moment as an industry, and I don't think anyone's going to be cashing in anytime soon.
And one of the ways, I don't think it's been a super boom. If you were feeding cattle in 2019, like George and I were, you wouldn't think it was much of a super boom, being only a few years old. And even the grain markets, that this current very strong prices. This was a different story not that long ago. So how we think about Australian agriculture in terms of its opportunity is relative to other assets and its capacity to basically to generate an acceptable return for the risk. And one of the very interesting ways to standardise agriculture around the globe is to look at what you've got to pay to produce 1 tonne of grain. So let's say wheat. And Australia still sits against other countries with similar levels of sovereign risk and economic strength right at the bottom of the amount of money that you have to pay to produce that tonne of grain. And what we see as really being a driver for so many of the institutions, the foreign institutions that come into Australia, is that they've seen this play out. That, you know, an American institution has seen what the Midwest has done, and the fact that it's multiples of that to produce that tonne of wheat. And so on a relative basis, and everyone in this industry knows, you know, how agriculture performs as an inflation hedge, as a store of wealth, as its low correlations to other asset classes. We all know that story. But I just wanted to make that point that relatively we're still really attractive. And the key driver, and I think Andrew made this before, it's you've got to pay the bills. And while ever you are able to be selling your beef or selling your grain, and then it's a function of your costs, and yeah, costs are going up. But we're still, as an industry, able to produce acceptable returns. And the thing about our industry is, you know, the mining industry might be able to benchmark themselves within a range. Our industry performance goes like this, and we've got great producers, and we've got some you know, people that might be on a soldier settlement block that have you know, really not been able to generate acceptable profit for a long time. We've got so much evolution in our industry to go through, so that we are a more efficiently priced asset, and generates those target returns. So yeah, I think far from a super boom coming to an end, I think we've got a lot of upside ahead of us.
Thank you. Cole Medway from LAWD. Just a comment about when to get out. The wealthy families in ag that I know, they never get out. But Anthony, just a point of clarification. You spoke a little bit about fractional ownership of ag land, and obviously a little bit of a trend developing in the States, and there's been a few deals done here. I was just interested whether you thought that was I wasn't sure whether you thought that was a good thing or a bad thing, or you're worried about regulatory controls, or, you know, linking it to MIS schemes and things like that. But just interested in your comments. So clarification on that, really.
No, I think it's a good thing. Like anything that can harness investment into agriculture is good. It's really got away from the individual, you know, with consolidation. So anything that can provide individuals with the opportunity to invest, I think, is a good thing. You know, the MIS in theory was a good idea. The execution was poor. So I think if there's suitable regulation around it, then, you know, I think that's positive. And from agriculture's perspective, it's another pocket of capital, and you know, and capital's the thing that we need to optimise the assets that we have.
Matthew Cridland, I'm a tax partner at Carnell Gates. I've just got both a comment and a question. So the comment is just in relation to the FIRB fees that you were talking about at the outset of your presentation. I actually think it's actually a federal stamp duty, so it should actually be called such. But my question is, with a raft of state-related tax changes, so we're seeing, you know, land tax reform in Queensland, Victoria's looking at a windfall gains tax, are your investors, and in particular your foreign investors, cherry-picking which jurisdictions they invest in based on, you know, the local states and taxes?
Yes, short answer.
Thank you.
Thanks for your comments today. Cheryl Kalish Gordon from Rabobank. Just interested in a general comment from each of you about the patience of capital and what the current global turmoil and food security issues, as well as the performance of agriculture during this, as well as ESG, means for that. Is this enduring, or is this a sort of a blip?
You want a short answer on that? Interesting question. Agricultural returns are more heavily weighted to capital gain than they are to income. And as a result of that, they're generally longer term type assets, so they're longer term holds. So capital does need to be patient. You know, there's good returns that are there for that. So I think patience is a key element.
Sorry, just to clarify, do you think that the investors, the general public, the people with the money are becoming more patient so we can marry up that profile of returns versus expectations in the market because of those issues? Yeah.
And there is a class of patient capital out there, and Brad will talk a bit more on this. It's sort of interesting. Short-term investors struggle, I think, with agriculture for the reasons we just noted, and a lot of capital is short-term here in Australia. So we know the listed markets are relatively short-term, and as a director of a listed agricultural company, what we're trying to do is go through a branded beef exercise to improve the returns that give people the short-term thing that they're looking for so that they can hold on to those capital gains, which in AACo's books were quite significant this year. But even Australian institutional investors, because we're a defined contribution concept, so you put your money in and you get what returns come out the other end. Everybody's very focused on what the returns are today. And you're benchmarked against every other superannuation fund. So if your returns fall below the others, people will take their money from yours and put it with the other. A lot of the offshore funds are defined benefit funds, where you know how much money you're going to get out the other end. So they're less focused on today's performance and they're more concerned about what it'll be in 10 or 20 years' time. And in that case, people just want to know the assets there. So you get a big chunk of land in Australia and that's gold. So I think they're the patient capital that get to play that game today. Australian institution funds, I don't think, get the benefit of that patience. And as somebody pointed out the back there, that Australian farming families, and they're large and they're becoming institutions in their own right, they're very patient because they've been generational to date. As to geopolitical things, there will always be something geopolitical happening in the world. It's just one of those things that we deal with. We ESG, I think we sort of chatted about a bit before, and I think, that becomes important.
In terms of the capital and patient capital, I think it sort of depends on whether that capital is for land acquisition, land improvement, working capital, plant and equipment, all of those different, there's different pools of capital. I think if you've got impatient capital in that working capital cycle that isn't prepared for a drought or a flood or some sort of event, and they pull the rug at the end of a bad event, that's when you see a lot of farmers come unstuck. So I think it's, basically that short-term impatient capital is generally dearer and generally only taken by farmers as a last resort. And so, I think there could be some improvements in the way that sort of capital is dealt with and provided, but I think that's always just going to be a part of the market. If you're not going to be patient in terms of investing in property, you probably shouldn't invest in it. I think the average capital growth of farmland, yes, it is 5.5-6% is the norm. We've had some larger returns recently. It could flatten out for a while, who knows? But basically, it's an asset class that if you're going to be investing in it, you need to be reasonably patient. But I think a lot of the investors that are doing what these guys are doing are making sure that capital is deployed in a clever way where it is improving the value of the land well in excess of any CPI growth through a change of use or through improvement in the land, and that's probably where it doesn't just need to be patient capital, but it needs to be smart capital. And to the point about what's going on globally, it's nothing we can do about it. So I think basically we've got a resilient group of farmers here in Australia who will just deal with whatever's thrown at them the best way they can.
I think most of the good points have been said, but maybe to give you some specifics. So investors that we work with generally think about their horizon as being, say, a decade. And I think obviously with strategies that are more focused on private equity, they tend to be a bit shorter. But, and Cole mentioned the long-term strategic position in agriculture, which is that's real value in a portfolio is the non-correlation to the volatility that's in equities or less correlated to say commercial real estate. They're really evergreen or long-term holds. And my colleague Dan loves telling a story of a German investor who, when he asked how long has he been investing in ag for, he said, 800 years. And and those long-term holds with, and they work really well with a lease out. That's really where you're seeing a lot of growth in the volume of capital coming into agriculture. And you know, if you look at and foreign investment in agriculture has grown over the last 25 years. I think it was in high single digits. It's now sort of up in the high teens, and that's a bit misrepresentative because it includes any investment that has a foreigner in there. So let's just say it's growing, but a lot of that growth has been coming from that sort of strategy, which is permanent capital, some or all lease revenue, and just set and forget and put it in your portfolio.
G'day guys, Mitch Adderman, ex-banker, now humble public servant. Would you have a comment on the role of government, particularly filling the market gaps in funding and capital, perhaps around innovation, agtech, ESG, but yeah, the role of government in filling those gaps? Thanks.
Absolutely, but I think one of the things that we've seen not necessarily work is direct funding from government or quasi-government to achieve certain objectives that, on the whole, aren't really in the long-term interest of an industry. So, there's this ongoing cycle of droughts and drought funding and then drought funding reviews, and then everyone forgets it and has a few good years, and then we have a drought. And capital going in, and I was an aspiring young farmer when there was a big debate on young farmer financing, and I look back at it now and I think how ridiculous. Why? Because you're young, should you be given money to go and do what you want to do? There's hardly any industry that works like that. So why should agriculture? And I think this entitlement in agriculture, this entitlement mentality in agriculture is fading, and it's a good thing because it's making everyone more competitive. It's making everyone commercially sound. But to address the externalities, things like environmental policy and incentives to do the right things are how you affect change, and so we see that as a positive contribution of that policy can make.
I think there's a useful role for government in education. There used to be a whole bunch of extension officers out there that used to take best practice and made sure that best practice was spread among the community, like among the farming community more generally, and that's really worthwhile, because then you end up getting a higher level of practice across a whole district. There's not as many as extension officers as there used to be, and generally these things are now run by commercial enterprises that are there basically as a selling exercise more than an education exercise. So that's one interesting area. I'm sort of torn on the next comment. Like, we used to have CSIRO and those guys developing all sorts of wonderful things that would then be made available to the farming sector. And what's happened now is a lot of that stuff gets passed off into ag tech funds. The technology, the seed technology, whatever technology it is, gets privatised and then is charged out at quite a rate. So I'm sort of torn between the free marketer in me and the rent taker. So it's that rent taking that happens off technology now that didn't happen before, and that's pulling money out of farmers' pockets. And the other area where only the government can play a role is the fine balance between the environmental. So a farmer must be exercised only by its economic considerations. They're naturally sustaining, but how much water do I take out of the river? All of those sort of things. So how you balance the community assets, which is the environment, and the farming assets, and how do you get that balance right? And I think that's always a role that just the government can play, and that's a really tricky role to play, so I'm glad I'm not the one that has to make that decision.
Yeah, I agree on the investment into things like CSIRO and the CRCs that used to yield a lot of really good outcomes, but there was also a lot of research done that didn't really add much to the equation as well. I think the investment into infrastructure is a big place that government can play in Australia. Investment into rail networks, water storages, delivery infrastructure for all of the other components. And then also, you know, we're known as one of the best producers of produce in the world, low-cost producer, but a lot of time we lose our competitive advantage before it gets to port. So I think one of the big areas that they could improve on and could invest in is our infrastructure to move those commodities around the country more efficiently.
We might wrap it up there, ladies and gentlemen. If you could join me in thanking our panel today.